Welcome to your weekly market update. I apologize, I was out of pocket last week. Hope my team took good care of you. I was speaking at a real estate conference, learning more about what's going on in our economy and most importantly in our real estate sector, which, by the way, I still believe is the best place for your money. We have regional banks failing. We have pressure put on big financial institutions. The stock market super volatile. Treasury bonds are performing at negatives on the long-term bonds. The short-term bonds are performing very well. So where do we put our money? What's the safest place? I think it's real estate right now. So continue to look for your home. If you already own one and you're watching this, go get a rental. I've bought several over the last year because I see the shortage in the supply and the massive amount of demand despite these higher interest rates. So why did the May 11th report that I was talking about work temporarily for interest rates going down, but now they have gone back up? Over the long run, May 11th report will help. Let me show you the charts. So when we look at these charts, we see this is May 11th. We had a really good rally. Green is really good. Okay. Red is also good. You can see we correctly called to lock in rates right here. This is why you work with an expert like me. I know these markets like the back of my hand. My team captain knows these markets like the back of their hand. So we saved many clients a 0.25% in interest rates from this rally up. We locked here and it has since deteriorated. So why is it deteriorating when the consumer price index report from May 11th clearly showed inflation is coming down like we predicted that it will? Well, this is short-term pain from the Fed's decisions of continuously raising interest rate and the strain of our financial markets. The cause of this has been from depositors removing money from their banks. I've done so myself. I have very little money in my banking institutions right now. It's in real estate. It's in safe treasury, short-term bonds that's getting a much better return than my savings account. It's in places where I can make more money and it's still safe. Real estate, I bought some land. That's where my money is at right now. That's in excess of paying my bills and 3 months of my expenses. So I've pulled my money out. Many savvy investors and even people that don't know that much about banking can clearly see, hey, I'm not making any money on my savings account. I can make 5% in a 6-month treasury bond. Why wouldn't I go get that 5% if I don't need this money over the 6 months? So that's what's happening. And what that does is it pressures these banks to sell their bonds, okay? Long-term bonds almost always pay more, which means the bank's profit, than short-term deposits. That has flip-flopped. So now this pressure on the bank, when someone like myself pulls out their deposits, right? They only have 10% of that money. So how do they get the other 90% of my money that they've lent out? They have to sell their bonds, and they're selling them at losses. And you would typically raise capital through issuing more stock of your bank to raise capital to pay your depositors back when they pull out the deposit, but their stocks are getting hammered because regional banks are dropping like flies due to the pressure that our Federal Reserve has put on these institutions. So this is temporary. It is short-term pain. As you can see, the market has deteriorated since May 11th. So like I tell many of you, hey, you can't check with me each and every day and expect things to be the same. It is changing day by day, sometimes 3 to 4 times per day. That's why you got to work with an expert like me that knows these markets, knows where to lock you in. I clearly did the best thing for all of my clients that were in process. Some of them were in process since May 1st without me doing a rate lock. You can see that was scary for me here. These are higher rates. This is higher rates. but I knew to hold off until May 11th, like I've been predicting all year. And it was 1.5 days where we could take advantage of these lower rates that we hadn't seen since April 7th. So long-term mortgage rates will follow inflation. They will come down. We got to get through this short-term pain that the Fed has caused our financial institutions. Hopefully you're not like me and pulling money out of the bank, but I'm going to do what's best for me and my family and the rate of return on the money that I worked so hard on. When I just paid taxes of 38.5% of my total income going to taxes, I'm going to get returns on whatever money I have left over. So that's what's going on in the markets. Prices in homes continue to go up. We're here to navigate you through this. If you have any numbers you need us to run, 312-731-4939, or email us, chad@thelubengroup.com. Make it a great week. We're here for you and your clients throughout these crazy times.